Good afternoon, everyone. My name is Nick Deacon, and welcome to this Reuters Events Webinar, Are Tankers on the Road to Recovery, in partnership with Kepler. Without further delay, I'm going to hand over to our moderator, Paul Chapman, Managing Partner, Human Capital, a search and talent advisory firm focused on the commodities markets, and also the host of the HC Insider podcast. Over to you, Paul.
Thanks, Nick. Looking forward to this discussion on the tanker market is on the road to recovery after a challenging 2020 and a challenging start to the beginning of 2021. And before I introduce the panelists, I'd just like to say that we're inviting questions in the chat, so please do post those and we'll try to get to them. So thank you to our panelists. First, we've got Peter Sand, Chief Shipping Analyst at BIMCO, Richard Matthews, Director of Consultancy and Research at Gibson, a shipbroker, and finally, Matt Wright, Senior Freight Analyst at Kepler, a data analytics company focused on facilitating global trade. To tee us up and give us an overview of what's gone on in the first half of the year, Matt's prepared a couple of slides for us just with the data and some insights on the market for the first half of 2021. So over to you, Matt.
Thanks, Paul. Just wait for those slides to come up. Great, thank you. So yeah, I just thought to kick off the discussion, it would be useful to look over a couple of charts that we can use to then talk around a bit later on. So moving on to the first slide, looking at demand to start with, and China specifically, which is so often the barometer for the crude tanker market. So as we know, crude inventories built very steeply last year, and this year they have been declining, but there is still quite a way to go. So even with generally lower imports, especially in the last couple of months, inventories have been very, very sensitive to any short-term increase in imports. Even, the last couple of months when imports have been well below, 10 million barrels a day, we've seen builds in stocks. So the point here that I really wanted to make was, as a platform for the second half of the year and looking ahead to next year, it's not necessarily a great position to be in. We've not seen a huge drawdown. We can talk a bit about why that has around high levels of refinery maintenance, etc. But even with imports at relatively low levels, stocks have been rising, and even recently we've seen a stock build over the last couple of weeks. Okay, then we'll moving on to the next one. So now on the supply side, so this is more of a summary view of our view for the next 6 months and moving into next year. So average increases this year have been relatively modest, starting in January when OPEC Plus delayed the most recent reduction in cuts. And while average increases of the year are projected to be around 2.8 million barrels a day, by the end of the year, we expect output to be up significantly. So here it's a bit more of a positive picture potentially, where the output, with OPEC finally coming to an agreement the other week with 400,000 barrels a day coming online every month now through to December, we should start to see a lot more crude actually making its way to the market. Whether all of this makes it directly into exports is to be seen. I think maybe over the summer we'll have some issues. We can talk about that in terms of direct crude burn in the Middle East. So while you're looking at the dark blue bar, average for the years is not the most exciting number, towards the end of the year, actual loading should be a decent amount higher than where we currently are. And then looking ahead to next year again, some further increases and a higher average for the year, which is definitely what the crude tanker market needs. OPEC will obviously be the main contributor to this, and with the oil price at where it stands, there's going to be some increase in shale growth, but we'll come on to why it's not necessarily going to be as high as it could have been or would have been a couple of years ago. Okay, moving on. So now turning to the clean, sorry, go back one slide, we've just jumped ahead there. So just looking at clean, and here just starting with the MRs, which account for well over 50% of clean product flows. So here, what I wanted to show here is this is the split of the MR fleet east and west of Suez. And as you can see, prior to the pandemic, there's a fairly balanced split, with the number of MRs trading east of Suez increasing steadily in line with greater demand in the region, which makes sense. And then we hit the pandemic, and there's a huge amount of volatility. We've got collapse in demand, so loadings, and then we've got spikes in demand for floating storage. And now we were settling back into a period earlier this year where east of Suez numbers were rising again, in line with higher demand in the region. But in the last couple of months, we've started to see this reverse. And what I wanted to highlight here was the fact that actually the Atlantic Basin is proving to be a bit of a stronger market now for MRs, which is contrary to, I think, expectations earlier in the year. And this could be a point we talk about a bit, is whether higher vaccination rates and the goal of zero COVID in some Asian countries is actually working against them from a oil demand point of view, and then for the clean tankers. Moving on to the next one. So here we're looking now at the long haul flows, and it's a bit of a mixed picture. Generally, west to east naphtha flows have been very strong. Starting the year with the return of some South Korean crackers. Imports of naphtha into Asia Pacific are now well above 2019 levels. But then on the flip side, the east to west has been slower to recover, with volumes still falling on some routes. European gas oil imports, hit 2.5 million barrels per day in June, which is, around the 2019 average. But most of this has been sourced from the Mediterranean and Russia on MRs. And so the long haul routes from the Middle East and Asia are not getting, on LRs, are not seeing the benefit. So it's a bit of a mixed picture. While we're starting to see the recovery in volumes, the LRs aren't seeing it all there. So that was it. I didn't want to go into too much detail, just a couple of slides to sort of kick things off.
Thanks very much, Matt. There's a lot to unpack there. The first thing, you finished there talking about this shift from east to west, particularly of the MRs. Richard, can you give us your take on that? What's behind that? What factors are driving that?
Sure. I mean, if you look over the sort of trends of the last few years, we've seen more refining capacity being gradually added east of Suez, and we've seen rationalization taking place in west of Suez. So over a gradual period, tanker owners have been shifting more of their tonnage to the Eastern Hemisphere, where demand has been strongest. But then if we come back into this year and we look at the pandemic and the effect of the pandemic, we can see that actually there's been a change in dynamic, where at the moment we're seeing much higher vaccination rates in the West, particularly if you look at the US, for example, which is a very important market for MR tankers. We've seen very high vaccination rates. We've seen a massive reduction in lockdown measures, and we've seen high mobility there. And of course, that's been stimulating trade into the US, and also trade, not so much out of the US, but at the same time will eventually stimulate their export trade as well. And again, Europe is now performing much better. So generally, the Western Hemisphere has been performing more favorably for product tankers. If you look at the East, as Matt said during his presentation, they're very much pursuing a different strategy of much lower caseloads and are behind on the vaccination program. So I think it's a short-term distortion. I think over time, we all know that the demand growth is likely to be stronger east of Suez, but that will depend on these vaccination rates increasing. So short-term distortion, tankers move around the world, they'll effectively move back to the market that pays the higher freight rates in the future. And that will likely be both east and west, but there has to be some balance between the two. Thanks.
Peter, what did you see in that presentation you think is not just a short-term distortion, but a long-term trend manifesting in the first half of 21?
I think the starting point for many discussions in the shipping market is always that of freight rates. So I guess allow me to pinpoint the one thing that Matthew may not directly pinpoint, the fact that the tanker freight rates have more or less been loss-making for the past year or so, since that OPEC plus price war was delivering a huge spike in demand. And that's basically also what we are about to see now unwinding if we fast forward to today and the immediate future. That demand that was pushed forward last year is of course demand that we will not see repeat itself, because that was also like what we saw shown by math graphics in terms of Chinese crude oil stocks still being elevated. And obviously there's always a question about whether these are strategic petroleum reserves or whether they are somewhat an indicator of a growing demand fundamentally, where they have a certain requirement in order to make sure that refinery throughput runs can get whatever they need constantly. So I guess the one thing that I touch on is when will we see freight rates become somewhat better than they are today, where time charter rates are also only for MRs at break-even levels. So if we are seeing any MR time charter deals done right now, they are not profitable at all. They basically cover the costs, and we see no time charters for that of crude oil VLCCs, because the indications are that no one is in rush to move any cargo soon. We basically see the indications from brokers. Maybe Richard can add a bit on top of that. The 1 year time charters for VLCC is in loss-making territory for new designs, even with a scrubber on board. So those are some of the things that I take note of in the current market and the road to recovery, which is absolutely still ahead of us, Paul.
Yeah, thanks for that. And I want to come on to the outlook for the next 6 months, but staying on the previous 6, you noted there about these are loss-making rates for right across the board. One of the things that did come out of the first half of the year was that many new build Suezmax and VLCCs have ended up taking clean products. What's behind that? I mean, I assume that figures into this weak demand on the crude side and some of the trends you've been talking about, long haul products. Matt, did any of you have any insight on that?
Yeah, I mean, carrying clean on new build crude is always happened. I think it's happening a little bit more than usual, and there's a couple of different flows and things that are happening, which is eating into the clean tanker market. So we've seen new builds, loading clean, but they're not necessarily loading clean in East Asia. That they're actually going to India or the Middle East and picking up a cargo. So they could easily load crude. It's not to necessarily reduce the ballast. And then we've seen a big spike in them. In VLs and Suezmax is actually heading to West Africa, lightering off Togo, and then ship to ship on LRs and MRs into South America. And this has definitely been eating into a lot of MR and LR trade, in particularly LR trade that would otherwise have come from the Middle East and India. It's definitely opportunistic because of the weak crude market. But like as I said, clean products loading on crude new builds is not necessarily a new thing. It's just we're seeing more of it.
Yeah, probably just part of those distortions that you mentioned. Obviously, a key factor in depressing rates, or not necessarily obviously, but a key factor in depressing rates is jet demand in the first half of the year and previously. Richard, can you walk us through the jet story?
Yeah, I mean, when we look at overall clean product tanker demand, a clean product tanker owner doesn't care if it's jet or gasoline or diesel. It doesn't really phase them as such. But of course, jet is an important part of the overall global demand puzzle. And when we look at seaborne flows, and actually Kepler data will confirm this, you can see that flows of gasoline, diesel, those kind of products are close to where they were pre-pandemic, so recovering quite nicely. But jet fuel is that missing piece of the puzzle. And when you look at overall ton-mile demand for tankers, jet can be much more of a long-haul product. So we see a lot of jet loading out of the Middle East, coming into Europe. And likewise, we sometimes see jet coming out of Asia, heading into the Atlantic Basin as well. So those are long-haul flows, and they create a lot of ton-mile demand. And those are not missing entirely from the market at the moment. We're still seeing those flows. We've been doing some more shipments recently because we are seeing an increase in aviation in Europe at the moment, but it's still not back to where it was pre-pandemic. And until we have that, or that is compensated by something else, we are going to see a product tanker market that fundamentally underperforms. So the question is, when is jet demand going to be back to pre-pandemic levels? Well, it's not this year, we know that. Is it next year? Again, most analysts would probably call it being a bit further beyond that horizon. So it's definitely a headwind that the sector has to face right now.
Yeah, and we'll come on to the. I think, you know, when do we get back to the pre-pandemic levels across the board is going to be an interesting question. Just before we get there, one final one, Peter. One of the sort of the I guess anomalies of the past 6 months has been typically with such high scrap steel prices and this type of market, you see a significant amount of scrapping of older vessels. We haven't seen that. What's your thesis behind that?
Well, Paul, for more than a year now, we have basically warned the tanker shipping industry that they should not expect a flurry of ships to get scrapped. And in order for that to ease the balance, which is clearly off in the market right now with way too many tankers chasing too few cargoes. And the reason for that being, well, as you rightly mentioned, there is a multi-year high scrap steel prices right now. So it easily pops the question: should owners not take advantage of these high markets? But then again, if there is someone out there in the market offering $2 to $5 million in excess of that, those ships are traded in the secondhand market instead. So we have actually seen quite a busy secondhand market, and that has been fueled not by necessarily investors and owners anticipating a swift recovery, but the fact that some of that monetary expansion that we have seen on a global scale have basically inflated a lot, also in terms of asset prices, not only the stock market and iron ore futures, but surely also that of shipping assets. So that's one of the reasons behind only a limited extent of demolition. And in some of the records that we tend to follow, we see only 8, and that's 4 trading VLCCs and 4 VLCCs that used to do floating storage only. So it's an insignificant amount of tonnage that has left the crude oil tanker sector. It's slightly better off in the oil product sector, where we have seen something around 2 million deadweight ton being taken out of the market so far. But it's not the flurry that many of those bullish pundits were hoping for 1 year ago. And it all arises, of course, from the fact that 2020, despite the devastating second half of it, the first half of it delivered spectacular earnings, in particular, of course, in the second quarter with spot earnings for many crude oil sectors in excess of $100,000 a day. So you may lose some $10,000 a day on average now in the markets, but at that point in time, you made almost 100 extra profits every single day. So that, of course, have built war chests for those owners and investors, and that's holding back that balancing of the market. And of course, also in the end, extending the road to recovery in the end, when we look ahead to what we are hopefully at some point in time seeing in terms of a tanker shipping market, which will exceed that of the pre-pandemic levels.
Yeah, so there's that global commodity super cycle and inflation in there, and there is that floating storage of last year that made these outsized returns for the owners. It seems like that, Matt, from your presentation, floating storage is also winding down though, so people aren't necessarily expecting those trade opportunities to return, as I see it.
Yeah, for sure. Yeah, I mean that chart was onshore storage in China, but floating storage for sure is down. You know, it was from the peak last year. We're way down, but we're sort of, it was up around 200 million barrels at the peak in June, and it's now down, I think, around mid 70s to 80s. But we are still slightly above pre-pandemic of around 50. So there's still vessels tied up, but they are not. It's not providing a crutch to the market that it was last year. Last year when you had these vessels tied up, particularly the VLCCs, when after that spike that Peter was talking about, rates did come off quite sharply because there was such a drop in demand, and the OPEC cut, obviously on the supply side from the OPEC cuts, but a huge number of vessels tied up did sort of support the market to an extent. The difference that we're seeing the first half of this year is those vessels have left floating storage, they're back trading in the market, and we still have low output and we still have low demand. And that is why we're seeing these, negative earnings across the sectors.
Excellent. And just staying on this scrapping stories, I think it is interesting. I know that Richard Gibson put out a slightly, another viewpoint, which was that many of these vessels are being kept on to service Venezuela and Iran hit by sanctions. Is that a supportable story?
Yeah, absolutely. I mean, if we go back to scrapping, in our view, we're like, look, all of the drivers of scrapping are great. You've got close to a record high scrap price. You've got plenty of old ships. You've got a terrible market. So, generally all of the trades are loss making right now. So, why wouldn't you scrap? And also, if you look going forwards, again, we've got a lot of regulation coming in that will make it harder for these older vessels to trade. So the drivers are very supportive. But as Peter said, you've got a VLCC that scrap value might be $21-22 million, but there's someone out there willing to pay you maybe $25-26 million who wants to carry on trading that ship. Now, I'm always pretty suspicious anyway, but we've been following these vessels after the sales have taken place. And it's amazing how many of these vessels sail towards the Middle East or into the Atlantic, heading across the Caribbean, and suddenly their transponders go off. And you think, what are they doing? Sailing towards the Caribbean, you wouldn't turn your transponder off in that part of the world unless there was something that you were trying to hide. And then as time goes by, we typically see these vessels turning up in other parts of the world. We pick up them from other sources, and we can see they've been doing that Venezuelan or Iranian crude. And, that doesn't need to be a long-term play. You've only got to do, maybe 6 months, a year of this Venezuelan or Iranian business, and then you've made enough money to pay the ship off, and then you can sell it for scrap anyway. The freight rates being offered for this illicit trade, we understand to be, 10 times the current market. So it's pretty attractive for those people who want to do it. But of course, there's not much longevity in it. And if sanctions do get lifted, then these vessels will get marginalized from the market and most likely scrapped.
Still at a decent price. That teases up nicely to look at the next 6 months and where is there a potential recovery for the tanker market. There's lots of stories there, obviously driven ultimately by COVID. What are the Chinese going to do? There's the jet demand. There's also the sanctions coming off Iran and so forth. Peter, perhaps you can start us off with just a global macro view of what you see for the next 6 months and some of the themes we can dig into.
Absolutely, Paul, and taking the helicopter view of, or perhaps even from orbit around the world, as space traveling seems to be the name of this month, also from not only Musk and Amazon, but looking at China and India, those countries that have driven oil demand for the past couple of years and are also expected to do so going forward. Obviously, their fear for, say, another wave of COVID infections to hit them is putting a lid somewhat on the demand from those nations. But indeed, we need to look at the Far East Asia and China and India for that demand. And in many ways, they are very, very close to what we can term pre-pandemic levels. But when we hover around Europe and North America, we're not going to see pre-pandemic levels being breached until the end of, potentially 2023, giving us somewhat of a global balance by the end of next year. And I think in many ways, some of those stories always relating to COVID seems to give us a bad carry on that golf ball lifting off from the tee. But it is one of the things that at least we look at quite in details. What are the when do we see that global demand getting back? And in terms of Europe and in terms of North America, Europe left peak oil demand a couple of years back, depending on how the Biden administration is getting by its climate war is unlikely to see right now on the horizon how that will develop. But again, if you go by at least some of the lines that are put out right now, it seems as if global oil demand could also have peaked in North America also. And if we go to the South America, I guess that's where the Lambda variant is now taking its toll. But fingers crossed. I mean, South America have been battling fiercely COVID-19 from the very start of it. But in many ways, it hasn't impacted shipping that much, fortunately. Fingers crossed, not the Lambda variant will not change that predominantly. So across the globe, we are seeing only a steady and gradual recovery. Fingers crossed when we look forward now that the winter market will always give us some upside in terms of freight rates. But I have to say that if we look beyond the winter market, there's still a lot of say room to be made up. And if you look at OPEC plus, I think it was also pointed to earlier on that oil production in itself is not enough. You need that to be exported. But from a tanker point of view, obviously, the more oil being produced, the more oil is also likely to be exported, and that is of course good for business going forward.
Yeah, I know from your own writing that the view is that the peak demand, I think 2017 for Europe, you stated in 2019 for North America. So with those in the rearview mirror, it's very much looking at the developing nations for that future growth in demand. Matt, in your presentation, you alluded to the low vaccination rates and different strategies in Asia. What does the data show, if anything, about the next 6 months for Asia demand?
Yeah, so Southeast Asia, on the clean side, is a really, really important product sink. Huge net importer of products. A lot of that is refined in the Middle East, in China, and elsewhere. So we've seen growth in imports has slowed definitely in the last couple of months. I think January to March we saw pretty steady growth, but it's definitely come off. You've got countries like India, which are posting some of the highest numbers, COVID numbers at the moment. It is definitely a concern, and I think depending on how they come out of this, the current Delta spike will be key, and how they adapt their zero COVID strategy. What it means from a crude, I think starting on the sort of overall crude side, I think looking at China is a key one, because China's demand is going to drive main crude flows, and if crude flows are doing well, a lot of the other tanker segments seem to follow. China's a bit of a question mark there because, as I showed on those slides, we've got inventories are being drawn down, but they're not quite down. They're not down yet. There's some reason for that. There was a lot of refinery maintenance this year, so refinery runs were not where they were to require strong levels of crude imports. So the next 6 months is going to be very interesting. But just read this morning that a lot of independents are cutting refinery runs, have cut refinery runs in July. They're expecting lower import quotas. Whether this means that the state-owned refiners increase to make up for that shortfall, we'll have to wait and see. But the Chinese crude import will be a massive factor. On the demand side is where the question marks. I think then turning to supply, I think supply is a slightly clearer picture because one of the blessings, OPEC plus has mixed blessings, but when coming to an agreement last month, we have a view from now until the end of the year, 400,000 barrels a day. That is fundamentally good news for tankers, because assuming we don't have a huge reversal in demand growth from COVID issues in China or elsewhere, most of that will make its way into the export market. I think perhaps over the summer, some of the output from the Middle East, that's increase in production. Some of that increase in output may go to direct crude burn for air conditioning, etc. But particularly towards the end of the year, we've got August, September, October, you've got a decent, we're looking at a decent rise in output growth. Most of that will go straight into exports, and that is only a good thing from a crude loadings point of view. And when the VLs start to see stronger rates, it will lift all the segments below as well.
Thanks for that. A very clear picture. Richard, just going back to Chinese demand, what's your take on these import quotas being cut and the impact on the teapots as they're known, and what does that mean for especially on product exports?
Sure. I mean, you know, we're definitely looking at weaker growth in Chinese exports and imports this year for sure. It seems pretty evident the Chinese government is looking to crack down on the independent sector. Part of the justification behind that is to help achieve its climate goals in the future, but there may be more to it than that. So from an import perspective, we're definitely going to see China import less blending components, LCO, and other products they've been importing to make diesel. We're also going to see the independents now, of course, import less bitumen mix. Much of that was coming from Venezuela anyway. And of course, now with these lower quotas, their crude imports will be down as well. What they can't do, which they were doing in the past as well, was using the import quotas of the major state-owned companies as well to supplement where they had deficits. They do, of course, or potentially do, of course, have high stocks. So they could still maintain refining run rates by running down their stocks, their inventories in the short term. But again, they need export quota to push this product to market. And it doesn't look like they're going to be getting much of that going forward. So certainly it is a bit negative for product exports from the country. As we've just spoken about, crude imports to the country are also looking a bit more challenged, although we do still expect to see them growing year on year. And there's another point I just want to add in general, which we haven't touched upon yet for the crude tanker sector in a whole. High inventories, and when I mean inventories, I'm talking land-based inventories, are the enemy of the tanker sector. When the market's backwardated and refiners have high land-based inventories, they're less likely to take increased volumes of seaborne crude. But as the market goes through the rebalancing, as demand recovers and OPEC keep production generally below demand, those stocks are going to get drawn lower and lower and lower. And as we go forwards into next year, when demand does continue to grow, suddenly refiners are going to turn around and say, well, I don't really have much inventory, so I'm having to buy that incremental barrel from seaborne sources. And that tends to have a bigger impact on overall crude trade. So as painful as this inventory drawdown is right now for tankers, it makes the future look brighter when demand does return.
Yeah, so you've got a few things pushing a positive picture. You've got obviously the OPEC Plus story. You've got some of this drawdown of inventories. Where does jet fit into this? I mean, is there any view to it? Does anyone have a view that jet will recover through the rest of the year, or is it going to stay depressed? And I realize that's a tough question with the Delta variant spiking across the world as we speak.
Yeah, if I can add a bit on that, Paul, I think all the long hauls will still be very much missing in the world of jet fuel demand. We have seen domestic flights in China, in the US, and also up and coming now in Europe, picking up. But it is all of the long hauls that is limited. The travel restrictions that remain in place for battling COVID, which is limiting that of jet fuel. But please allow me also to conclude a bit on China and one of the long hauls that we see for VLCCs, because Brazil is normally one of the friends of very large cruise carriers when they export crude oil out of Brazil into China. But we have also seen somewhat of a weak support from that market this year. I mean, especially May exports in general, but in particular to China this year was horribly low, with June somewhat in a recovery mode. But if we look at the first half of the year in total, exports out of Brazil were down in general, and they were quite almost 10% down to China specifically. And obviously, when you have 10,000 nautical miles approximately from Brazil to China, that is putting a lid on tanker freight rates also. So going forward, of course, always relevant to look out for the long haul trades, not only out of Brazil, but in particular, of course, also out of the US Gulf of Mexico, if we are looking for the road to recovery.
Why do you have any insight as to why that in Brazil in particular that trade has dropped off?
I think it puzzles me a little bit what really went on in May, but in terms of overall political friendship between Brazil and China, they have a long-standing relationship, but also a very one-sided one, where there's a key leader. China says jump, Brazil says how high. But I would not necessarily call it a power play back in May, but merely a matter of timing in some way, and also due to the fact that I think Brazil basically peaked their imports also in May this year, exceeding more than 60 million for that month alone. So there's always a little bit of ticks up and downs when you do a monthly average like that. I saw also in the way that Matt early on presented some of his views, where you have like a running average instead, perhaps giving more of an indication of the trend. But I don't see the relationship being off here, but I definitely see that as a potential trigger to look out for, when simply due to the fact that ships and tonnage are tied up for a much longer period of time when China exports from Brazil, as opposed to when China exports from the short hauls of the eastern part of Russia or even Middle East. So that's not really the juicy bells that we're looking for. We need the long hauls. We need China also to take from North Sea. We need China to take barrels out of Black Sea in order really to find support in the market.
Yeah. Thank you. And we've got a question in the chat from Jack Shee, who asks, where do we stand from middle to long-term standpoint with naphtha supply versus LPG? I know that you touched on that in your presentation, I think, Matt, on the naphtha side. Could you talk to that?
Yeah, sure. Yeah, naphtha so far this year has been very, very strong. But as Jack points out, a lot of PDH coming online. I'm not an expert in terms of the flexibility on a number of these, the crackers and PDH. Crackers in particular have flexibility between LPG and naphtha intake, but for sure. And I think a lot of it, fundamentally, a lot of it comes down to price. If one of them is moving above the other, you're going to see some switch back. I think long-term prospects are good for both. I think the petchem sector is fundamentally where there's going to be the most strength in oil demand. And so I think both LPG and naphtha that's going to be, a lot of refiners are going to be maximizing. If you don't have an integrated petchem facility, you're going to be making sure you're maximizing your naphtha cuts to push out to Asia. And those facilities in Asia that are integrated are going to be the ones with the highest margins.
Excellent, thank you. So one of the, I guess, when you look towards the next 6 months, one of the big stories out there is Iran. Will the sanctions be lifted? If they are, that has quite there's quite a bit of discussion about what the impact would be, and it's not necessarily clear on the tanker market. Richard, could you start us off on that subject and give us the highlights of what you think would happen if those sanctions were lifted?
I could probably talk for about half an hour about this, but I'll try and keep it to 1 or 2 minutes. But no, I mean, look, fundamentally more oil in the market is good for tankers, and that's what we want to see. The question I always have is, well, would we rather that oil come from somewhere else? And that's nothing against the Iranians, but as Peter was just saying, I'd much rather see that crude coming out the US Gulf, heading into China and heading into Asia, than I would coming out the Middle East, just because of the ton-mile effect of that. But we still believe that Iran coming back is marginally positive for the sector. It's marginally positive because we'll have more oil for start. But also, as we touched upon earlier, there's a lot of very old vessels trading Iranian oil. And they're only able to do that right now because there's no modern vessels willing to do it. So therefore, they have that sort of captive market, that illicit market, as we like to call it. And for the VLCC fleet, that's about 10%. And I think for the Suezmax fleet, it's about 7% of the fleet is engaged in either Iranian or Venezuelan trade. Now, if sanctions get lifted, those vessels will not be acceptable to the buyers of Iranian oil. When I'm talking about the buyers, I'm talking about the companies that currently don't buy it and only buy it if sanctions were lifted. So those vessels will very quickly get marginalized and taken out of the fleet and probably end up being scrapping. So it's beneficial from a tanker supply perspective. Not all of them will be scrapped. We have to remember that the National Iranian Tanker Company has about 40 VLCCs, and most of those will probably stay trading and will deliver crude on FOB contracts. But most charterers or most traders who buy Iranian oil will probably want to buy it effectively FOB, and therefore they'll use their own ships. So it's going to take some old tonnage out of the market. It's going to bring more oil into the market. Of course, you have to balance that and say, well, if Iran is pumping more, then it probably limits the ability of the rest of OPEC to increase production. But we still think it's marginally positive overall for the market. Whether it will happen or not, I think there's still a lot of uncertainty around that. We have a new president in Iran, of course. Talks with the US are yet to resume. We understand that will take place in August. So there's still a lot of uncertainty around it. I think it's taken longer than people expected, but eventually we think it will probably happen.
So potentially, a net positive. Peter, what's your take on Richard's comments?
When I try to get my head around these political aspects of tanker shipping, I always get excited because that is often what delivers the freight rate spikes. But mostly when sanctions are invoked, not when they are lifted. So getting back to the talks in Vienna, normally when we hear very little about the talks, it's positive because then diplomacy basically finds its way to work. And from an economical perspective and from a perspective of humanity, I think it would be great if the JCPOA would be reinstated in some way. But to be honest, I don't see it happening. The new leadership in Iran hasn't changed a bit in terms of the fact that the supreme leader remains the same. He is indeed a hardliner, and it's unlikely that they're going to bow into any deal. They would likely the Iranians would love to see the upsides from a lifting of sanctions, but they hate to give in to anything. And we have seen through many years of economic decline in Iran that is not something that they put much emphasis on. I think Richard puts it out very, very kindly in the sense that it may be mildly positive or marginally positive to the market, but it may rest predominantly on the fact that the fleet factors could play favorable into that of the freight rates because of the fact that those barrels are likely to find a short haul home, and that is of course the one thing that limits the extent of which we can see long haul barrels, which we love the most in shipping.
We are getting quite a few questions in the Q&A about the longer term impacts of energy transition. So I kind of want to move the conversation a little bit further out and the longer term view. Before we get there, does anyone have any sort of wild cards that might have affect the next 6 months? It sounds like there are some green shoots with increased supply, hopefully a continued recovery of demand in the West. It strikes me that it's really down to vaccination rates and impact of variants, but I don't know if anyone has anything we've missed as we look to the second half of 2021.
But this is tankers and anything can happen, right? What do you want? Do you want a container ship wedged across the Suez Canal? Do you want, some sort of tanker being bombed in the Persian Gulf?
Texas freezes.
Whatever, anything can happen, right? And it always does in tankers. So you can never forget there will be those events which create a lot of volatility. But you've kind of hit the base case, on the head. It's, effectively we are seeing demand recovering. It's going to take time to get back to pre-pandemic levels, but everything's moving in the right direction. I'm not sure it can get much worse. I mean, that doesn't take much analytical power to predict that, but it looks like we are slowly moving in the right direction. But there's nothing to say that suddenly tomorrow we'll be back in profitable territory.
Yeah. So
one thing we've not really talked about that much. We sort of alluded to, which is U.S. crude exports. We've said, from a tanker's point of view, it's what you want to see, and I think probably worth just talking a little bit about why we're not and why we're probably not about to for a little while, which is shale, right? So pre-pandemic at these kind of prices, you would expect to see a lot of that revenue being pushed into capex, more drilling, more output, and we're not. And the simple reason is a lot of these companies are shoring up their profit and loss, and they're pushing a lot more into paying down debt. So we're not seeing a lot of capex, increase in capex and new drilling happening. what we're seeing though is we are expecting to see some increase in output from the US this year, but that's mainly from the drilled but uncompleted wells, of which there are a lot. So, long term, I think there's a lot of talk about the death of shale. I think that's massively overstated, but the huge investment that went into export infrastructure in the US Gulf, which is massively underutilized, is still going to be underutilized for a little while longer. I think we're going to start seeing increases towards this year. I think we're talking 400 to 500,000 barrels a day additional billion this year, and then rising again. But that is not going to be. It's unlikely to be a positive wild card, if you see what I'm saying.
Yes. This question is directed to you, Peter. It says, Peter, this is from Richard Diamond, you've consistently been negative on every segment of shipping since I've heard you speak at the conference in London in September 2019. Is there any class of shipping you would buy today? And perhaps that is a nice segue to talk about what's going on in the container market and how that might actually affect fleet development, which is probably a bullish signal for the tanker market, at least over the next couple of years. Can you talk to that?
Well, first of all, I'm flattered that someone remembered what I said 2 years ago. That's extraordinary in itself. But in many ways, making use of that bearishness in a positive way. Take the most hated tanker sector at the moment now and put your money where that is. Because that is perhaps the best buy you will make in the market right now. Going back to the middle of the past decade, I was in Singapore talking about the container shipping sector, and at that point in time, the Panamaxes were, well, just walking stranded assets. I guess is a term nowadays. And if you bought one of those at that point in time, that would have been your pension funds in heaven and then some. But going forward and talking about the oil demand and the questions coming in, I think we are very much in the safe house in terms of oil demand for at least 2025 and also for 2030 to some extent. Recall that the pledges made by President Xi of China is that they're going to peak carbon emissions by 2030. Unlikely to be happening before that. Of course, it's not oil emissions, all of it. It also relates heavily on that of coal, of course. But it remains a fact that China is likely to fight carbon emissions mostly on the coal side and not so much on the oil side. So looking at also the not only the medium term but the longer term, I would not be afraid that oil demand all of a sudden evaporates beneath our feet. That whole, say, climate agenda needs time to get into the gears to put that transition thoroughly on the rails. And we are still very far away from that. I think mostly what we see in terms of renewables, of course, taking up some of that fundamental demand for energy on a global scale is merely biting into the chunk of growing demand, not so much into established demand already. So I know that I don't think I've been one of the bears for oil or for oil demand in the past a lot. Mostly been into the area of the ring where I have seen a huge demand for energy, actually putting somewhat of a cushion for shipping and shipping of fossil fuels going forward, at least, as I said, into 2030. Coal being perhaps the one exception, but also LNG seems to be in a sweet spot at least until 2030, and it originates from the fact that global energy demand is still very much on the rise, and any electricity transition is unlikely to eat into that of oil demand. It's more likely to eat into that of coal demand, basically due to the way that energy demand and production is structured today. Yeah, please.
I guess in a more concrete short-term view, it might impact fleet development in a positive way for rates, at least, in the sense that these are 15-year assets. you're talking about 2030. That's only, it's 8.5 years away. So are people going to be investing in these in a fleet now with these concerns over long-term demand for the ships themselves? And secondly, you are bullish on the container markets is doing extraordinarily well, and shipyards across the world are filled with orders for new container ships. So the argument, therefore, is that actually we might see rates supported by a lack of new fleet development, in the next at least until 2023. Richard, can you does that make any sense?
Yeah, I mean, it's absolutely okay. I mean, we're loving the fact, we're very much exposed to tankers, our company, so we're loving the fact that everyone in the container market and the LNG market is ploughing in and looking to invest in new tonnage, because they're taking all the shipyard slots away from the tanker market. So yeah, we're looking very much forward to really sort of 2023, 2024. We've still got quite a lot of vessels delivering next year, so I think there's something like 55 VLCCs due for delivery next year, and quite a large number of other vessel classes as well. So fleet growth will continue next year, unless we have something exceptional on the scrapping side, which at the moment is not looking hugely likely, although we're still very optimistic that will eventually come. But there's very few tankers for delivery in 2024, and it's pretty low for 2023 as well. So if we fast forward a couple of years, we get to say end of 2023, 2024, we've got world oil demand back above pre-pandemic levels. Suddenly we've got no new tankers coming out. Those vessels that should have been scrapped this year, haven't been scrapped, will eventually have to be scrapped. They've only probably got another 2.5 years tops left in them. So suddenly you'll have a much tighter fleet supply position, and you'll have stronger demand. So there's a bright outlook for the tanker market. It's probably going to take us another 18 months to really get to that bright outlook, but it is coming. But the key thing with this market is nothing lasts forever. And we know that if we have a boom in the market, you normally only get that for 2 or 3 years. And then, like the container sector, we'll go and sow the seeds of our own destruction by building lots of new ships.
John Ogden in the chat asks, you just mentioned it there, that there is still, I think you said 55 ships coming into the fleet in the next year or so. Is that only going to, and in his words, rub salt into the wounds of the market in the short term?
Yeah, potentially. I mean, again, if you look at those 55 VLCCs, as we talked about earlier, those vessels are probably going to do clean products on their first voyage. So that's going to take away some clean product tanker demand during the first few months of their lives. And then, of course, they'll come into the crude market soon after that, and again, continually add supply, add to the supply side story. We're probably not going to see that same amount of vessels taken out of the market next year. So it's going to take a few years for the supply demand balance to fully redress. In our view, next year, we think that tanker owners on average will probably be around about break-even levels. It'll probably take until 2023 before they start generating some decent income once again.
And beyond that, one bullish note, especially on, I guess, the product side of things, on the clean tank side, is you've got this development of these mega refineries in the Mid East. That typically means more ton miles, as a compared to the historical refining complex. Matt, do you think that's a bullish signal for the future of at least the product side of things?
Yeah, I think it really depends. So one of the questions sort of alluded to what are the long-term prospects for product, oil demand, and I think, one of the issues that we thought we had a clear picture pre-COVID. Mature economies were on the decline, but emerging economies were making up for that, and so maybe peak demand was the mid 2030s, somewhere around there. So COVID's kind of thrown a spanner in the works there, because now a lot of the emerging economies will, once we've sort of recovered some of the losses, will continue on the decline, and the energy transition will accelerate, if anything. The emerging economies, some of them haven't benefited from the fiscal stimulus that developed economies have had during COVID, and so their ability to continue to grow their economies is maybe somewhat stunted. And so we're in a position now where we don't know how the oil demand is going to progress among the countries in which it is the most relevant from an oil demand perspective. I talked about Southeast Asia earlier, and I think that's they are a key area for future future refiners to look to and target for exports. Indonesia, Malaysia, Vietnam, etc. That is a big question mark. I think, we had, there's been rationalization in Australia, which is obviously a good ton-mile voyage. So I think, those refiners will do well to ship out to there. But I think the question will really be, how are, African and Southeast Asian economies going to bounce out of COVID? And the next 6 months to a year will be very telling.
Yeah, and I think it's a fascinating point that you raise, which is all of this discussion is largely predicated on the idea that COVID has ultimately no long-lasting impacts, especially on the trajectory of energy transition. And are we going to see a more rapid shift to change in hydrocarbon consumption? One thing that you said prior to this actual event, Matt, to me was that energy transition probably is going to do more to change the type of tanker that's ordered necessarily than the tanker market itself. How do you see energy transition changing the nature of the tanker market? I mean, perhaps Matt, you can kick us off on that.
Yeah, it's definitely up for debate. I think the shift, I think that one of the main factors is the shift in refining capacity east, for sure. You're bringing refiners closer to the sources of demand, right? So, it's becoming in some ways a bigger MR market, particularly with, prior to recent events, huge amount of product coming out of China, which was serving the region. Not to go off on a tangent, but it really does look like, Chinese product exports are going to be on the decline for a little while anyway. We're expecting to see export quotas slashed quite significantly this year. There's talks of them maybe only reaching, 40 million tons, which is nearly 20 million tons less than last year. And based on that, we're already past halfway for the year. So we're going to see less this year. And, whether that's around the Chinese government's ambitions around the energy transition or their wish to control the independence, I'm not sure. But, that's a significant event, because China didn't really ever plan on becoming a product exporter. They wanted to be self-sufficient. They just invested very heavily, and independence went wild. And now they are they have been a huge product exporter in the region, which has been serving the region, serving, Southeast Asia. So, that was a good MR market. Now, where are these developing economies going to be sourcing the incremental barrel from? Middle East, most likely, which is definitely good for ton miles.
Peter, another macro question for you, but staying on that theme of energy transition and impact on the tanker fleet. There's a question in the chat from Carl Jeffrey, who asked, do you think CO2 shipping market could be of interest to the tanker operators one day? What's your take on that, and more broadly, energy transition's impact on the market?
I don't think shipment of CO2 will make a huge impact on the tanker markets. I trust that any significant impact on climate change, you need to capture the CO2 at the origin source. So very limited tankers are likely to get employed by that. But having said that, I mean, those first movers that we see already setting something up, transporting CO2 from the northern part of Europe to Iceland, is of course perhaps an omen of what may come. But I don't see that as a big play going forward. But surely, when looking at the energy transition and that of transportation, which of course takes up a huge part of the oil demand, that is of course tricky in terms of passenger vehicles, much more than it is for trucking and long haul trucking in particular, that relies on distillates other than gasoline. So what we see in terms of the shift to electric vehicles on a global scale, it is still very slow, at least in the way that we see it. Even though you can paint quite bullish pictures on the uptake of EV sales on a global scale, you always need to put that into perspective of the present fleet of passenger cars and trucks on the global scale. You may see sales grow quite significantly over the next decade or so, but there's still a massive fleet that needs to exit also the passenger transportation sector in order really to bite into that fundamental level of demand and basically get that into reverse, impacting tankers significantly when that happens, and most likely beyond 2030.
Yeah, I know we're starting to wrap up here, but to you, Richard, one of the things that certainly is part of a broader ESG initiative globally, but certainly in the West, is going to be responsibility around scrapping older vessels and regulation and so forth around that. As those restrictions or those policies increase the costs incurred by ship owners, what does that happen? How does that impact the tanker market? What do you see with the fleet? Does it just continue to age, or?
I'm not so sure it has a huge impact. I mean, you'll see many of the European tanker owners tend to divest their assets at a younger age, where they can still be sold for further trading. So I'm not sure it has a huge impact on that. And there's some owners as well who will just anyway just sell the vessels and not worry about it too much. But we have seen a few cases where some companies have been dragged through the mud a little bit for their scrapping activity, and hence now where they tend to get rid of their assets at a younger age. But it's more about the European owners in particular, and more now trying to lead the agenda when it comes to investing in the next generation of tankers. And the big question right now is what should be fueling that ship? Should you still go for a conventional tanker burning oil-based fuels but look for the most efficient vessel possible, or should you go for something burning perhaps ammonia or even further down the line hydrogen? The answer right now, clearly the industry doesn't know. Many owners are trying to adopt a flexible approach whereby they order an ammonia-ready tanker, an LNG-ready tanker, or even an LNG-powered tanker. But at the moment, there's still no clear consensus on what the best path is forwards. But clearly some owners, certainly from an ESG perspective now, want to be seen to be investing in the greenest vessel possible or available to them right now. We'll see more of that trend continuing.
And then finally, I guess a good question to end on to you, Matt of Kepler. Petros in the chat asks, what is the current position of the tanker shipping cycle?
I think over the last year, it's almost impossible to know. I mean, we're definitely on a recovery. The supply signals and demand signals are positive. Like Richard said, it can't get much worse. We should be through the worst, unless there is a sudden reversal or a spike in COVID that sends demand in the wrong direction, or OPEC fall out again. But actually, if OPEC fall out again, it might be a great thing for tankers. We're at the bottom, and the only way is up.
Yeah. Well, I'd like to thank everyone for participating, our audience, and then also our panelists. Thanks very much, Matt Wright of Kepler, Richard Matthews of Gibson, and Peter Sand of BIMCO. Back to you, Nick.
Thank you, Paul, and thank you again to Matt, Peter, and Richard. That was a really fascinating discussion. From everyone at Reuters and our partners for this webinar, Kepler, thank you for listening, and we'll see you again soon. Goodbye.